most people will sit there and they know what oil is, they know what gold is, but I'd say less people know. I think they know what soy is, but they know less ways to play it. Like, okay, so if I have this view, I agree with you, Chris, what do I do? Like, how do I play soy?
So my largest bets, aside from, I'm short the commodities outright, corn and soybeans via puts and futures, but you
Are
can
those
also,
easy to get off? Like with like some level of, like if you have a super bearish?
super liquid. The daily volume in these is hundreds of millions of dollars a day.
Okay, so you're good.
They're super liquid.
If I go out and I want to buy the soy puts that are 25% below the market, is that a market that I can get?
Yep, very liquid.
Get it on,
especially in the first 9 to 12 calendar months of the year. Yeah.
Really good. Okay, so shorting soy is a good way to play
yeah.
soy. I get
yeah.
that one.
And then also, I'm short capital equipment manufacturers that sell largely to U.S. farmers, because the forecast for U.S. farm income over the next few years is as bleak as it's been in 50 years. I've looked at all the data going back to about 1971, and the outlook where we sit today has never really been as bad as it is today in terms of what farmers should expect for income given current crop prices and the current input prices. So I'm short John Deere. I'm short a company called Lindsay Corporation that has sold a lot of irrigation equipment, not just to corn and soybean farmers, but to a lot of the marginal acres that under lower corn price environments don't even make sense.
That's LN?
LNN,
Yep.
Yep. Lima, November.
Okay.
I'm short Monsanto. There's a company in Canada called Ag Growth International.
Oh boy.
And they sell grain handling equipment. That one's funny for a lot of reasons.
And I'm from my hometown, Thunder Bay, Ontario, which has the most grain elevators, contiguous elevators in the Guinness Book of World Records. That's nice. Like, we have the most hockey players and we have the most grain elevators. So I'm very familiar with actually that company, and that's just a random data point. But it doesn't change the fact that a lot of Canadian equity cap, if you will, whether it was gold miners, E&P stocks, ag, they chase the same damn bubble.
Yep.
You're just basically saying that this is the most epic of all the bubbles because it's the one that, from a supply perspective, can go on and on and on and on.
Yeah. And the downturn in ag, it tends to last longer and be more severe, but it can be slower. But
just looking at all these, they all kind of look the same on a 5-year basis.
Yeah.
I'm talking about the stock prices. It's like mega bubble. It's just in its first phase of breaking down. They're in what we would call bearish trends. How close do you think Wall Street consensus is to your bear case on something like Monsanto's most recently gotten hammered? You've nailed that, but Deere hasn't. I mean, this Lindsay hasn't been hammered per se. It's off its highs.
Yeah.
So where do you think consensus is versus where you are?
The consensus is very, very far from what the next few years is going to look like. And
really,
there's two issues with consensus and the bulls, I think. Firstly, and I've talked to most of the long holders in all of these names, including some of the largest holders in like a stock like Deere. A lot of those guys, they either only look at the last 10 to 15 years and extrapolate forward, but the bubble in ag has been going on for the last 10 years, so you can't look at data points from 10 years ago and think that that could be indicative of what today might hold. Also, what was unique to ag, in 2009, when the economy tanked, ag was unscathed because ag did not depend on capital to continue. So the disruption in the capital markets had no impact on ag. Ag continued to do really well, also helped by the growth in ethanol demand during that time frame. So some people look at 2009 in the ag stocks and they say, well, if this is the worst it can be, how bad could it be? Well, 2009 was a non-event in the farm sector. It didn't impact anybody. In fact, in 2009, farmers probably had one of their best years of the last 30.
Right. Well, that's also, in 2009 and 11, when the dollar is weak, you cut off the competitive sets, because you had global currencies were quite strong. Maybe not, the Argentine peso, but a lot of currencies really, that trade. Maybe that's why Trump, by the way, does so well with farmers. Yeah, he wants to shut off the rest of the world, which would be good for the American farmer, wouldn't it not?
Well, unfortunately, we depend on significant exports, which is interesting. Speaking of exports, as a segue there. So as we talked about earlier, the Brazilian real and the Argentina peso have both devalued significantly in the last 6 months. if you look at United States exports of corn and soybeans, despite the fact prices are lower in US dollar terms and stockpiles are higher, exports of each crop are actually down 10% plus in the last 6 months year over year. So you ask yourself, well, that doesn't make any sense. Why would that be? And the reason is because South America is taking that market share in the export market now.
And they will quickly. I mean, South America is under huge political pressure to basically offset a lot of their energy gains or a lot of that side of the resource trade with something else that's progressive where people will put capital and time. It's interesting. Back to the bear case on these types of stocks. As you know, Jay Van Sciver, you guys talk, obviously our analyst on Caterpillar, he just came out with his big bang Deere bearish presentation, I guess. Do you think that how you guys think about the captive finance side of these companies, Cat and Deere specifically, Deere is where I know you've done more work, I think more work than anybody on Wall Street. So do you think people A, understand it, and B, if the answer is no, can you explain it?
Sure. There's a couple of things with the Deere's captive finance that I don't think people understand. And with the captive finance company, what you are really concerned about is what percentage of the loans are ultimately not going to be paid, and then what type of write-offs will that finance company have to incur. And so for Deere, people look at the credit statistics I don't know if they're looking at the last 20 years or whatever, but you can look at data back 30 or 40 years. And if you look back in the 80s, Deere today is different than Deere in the 1980s. In the 1980s, Deere wasn't really a meaningful lender to farm equipment. They were in the business, but if you looked at the total amount of non-farm agriculture lending in the 1980s, Deere was a low single-digit % of all of the lending. If you look at it today, Deere...
It makes sense because interest rates back then, Volcker ripped rates. Nobody would be in that business. I mean, it wasn't part of the 0% rates business, 0% risk. Now Bernanke's got, I'm sure, quite the captive audience.
So in the 1980s, there were a lot of ag banks distributed all throughout the Midwest. And we had a banking crisis, and today there's not a lot of ag banks in the Midwest.
Credit unions and ag banks.
So you ask yourself, well, who's carrying all of that credit risk today? And it turns out it's John Deere. So
I thought because the tractors were nicer that it wasn't really credit risk.
Exactly. Because farmers don't have debt today, people think that then they won't have any problems with these leases. And Deere's finance book today as a % of the total non-farm credit in North America is somewhere close to 20%. It might be 16, 20%. It's a huge number.
Oh, wow.
And so when you want to think about where the risks are in the ag lending sector going forward, I think Deere burdens a lot of that risk. And then you think about how well prepared are they for a potential downturn. And when you think about the preparedness of a FinCo for a downturn, you want to look at two things, I think. First, you want to look at how well provisioned are they currently. In other words, how much do they have set aside against the loan book for potential losses? And the second thing would be how much equity do they have in FinCo to absorb future losses? And in the case of Deere, we've got credit statistics going back over 20 years, and we've already talked about the farm outlook. It's not good. So you would think that if you were managing a very large credit book of $30 billion,
is that how big as well?
Yeah, you might have some higher provisions today than you did a few years ago.
Well, it's kind of interesting that like a lot of companies, even versus 3 months ago, got this wrong. The almighty overlord of Wall Street, Jamie Dimon, only like a month ago said, "Look, my bad debt provisions are A, my loan loss reserves are A," and then he comes out at his analyst day like a month later and says, "Wow, I had to take if oil's below 40, we got to take that up, 600, whatever, we put $600 million in there." This would seem that if they don't have the right bad debt provisioning, that it could be a lot worse, a lot faster going into what you're calling, the obvious, the harvest cycles that we're going into.
Yeah. So with Deere specifically, on their large credit book, they only have 53 basis points of provision at the end of 2015. Now, to give you historical perspective, if you go back to 1993, they have never had a smaller provision as a percent of loans than they had exiting 2015.
Wow.
The average over the last 25 years has been 1.35%.
This is crazy. So, in other words, I mean, can you back into how overstated? I assume that that's inflated earnings.
Yep.
I mean, do you know what the number?
Yeah, you would just take the 1%. So what I've done, it's a few $100 million a year, which is almost all of the FinCo's profits.
Wow. Just so that we, because some people may not know what FinCo. So you get the financial company, and the captive finance company is what we're talking about. The financial company, and then you got the operating company, or what you'll call OpCo. So you got FinCo, OpCo.
Yeah.
Okay.
The way that it works is, Keith is explaining, the equipment manufacturing company, which makes all the tractors.
What Deere should be in the business of doing.
Yep. And then they've got a bank on the side that helps people buy those tractors. And that bank has all the loans outstanding on it. And I think last year that bank earned a little over $500 million. We know that today they're provisioned 50 basis points. We know that in times of stress they've been provisioned over 200 basis points. So you say, well, if they had to add 150 basis points of provisions on a $30 billion loan book next year, that would take off $450 million of profit.
Wow.
On the $30 billion book, 1.5%. That would be the hit to earnings.
Oh, so this is how, like, getting back to how I like how you boil it down. You're an analyst of a very complex situation, but you're good at boiling it down, which, to me, that's the definition of intelligence in markets, which so you basically said, okay, like, there's two different things that you could do. You have to basically have provisioning, or you have to have equity.
Yeah.
So if now you have to go out there and raise your provisions to 1.5%, God forbid 2%. Let's say that Hedgeye is right, when we go into a recession or a farming recession, wouldn't, to me, half of the other is the other half. It doesn't matter. The equity piece is what they effectively be looking for, more equity.
Yeah, and in the case of Deere,
to offset that?
Yeah, it's complex. They have, I think they have multiple issues that should be in the process of being addressed that are not being addressed. First of all, we've got under-provisioning of FinCo. Second of all, they've been increasing the amount of used equipment they carry on their balance sheet into a market that we already know has too much used equipment. And then thirdly, if you look at their guidance for 2016, I actually think that the equipment company is going to be cash flow negative this year. And I don't think next year or 2018 is going to be much better.
So the OpCo goes cash flow negative, the FinCo is overstating profits. If the FinCo had the right provision, they wouldn't have profits either.
Correct.
So the company in the aggregate has to raise equity.
Correct. I think over the next couple of years, it's better than 50-50 that Deere will be in the equity markets raising equity. And
they wouldn't raise debt.
Well, what I think will happen is that they already have a lot of debt.
Yeah, I see that.
And they've been able to finance at very favorable rates. What tends to happen in the credit markets and life in general is when you need it the most, it's when it costs you the most type thing.
Yeah.
And with Deere, so they've got a $5 billion used equipment book now of equipment on leases, and that's in FinCo. FinCo only has $4 billion of equity. If used equipment prices were to drop just 20%, which I don't think is a crazy guesstimate, FinCo's equity would fall 25%. Why is Deere's equipment on operating leases, their used equipment, why is this number so high? And this is what gets to the negative cash flows at OpCo this year, and it gets to one of the strategic mistakes that Deere's management is making today. And that is, in the last 7 or 8 years, Deere has significantly expanded its manufacturing capacity, which they had to do because they sold twice as many tractors in 2013 as they did in 2006. On the downturn here, rather than address all of this overcapacity that they have, they've decided to stimulate manufacturing levels by having FinCo actually just buy new equipment from OpCo. And so this year, in the first quarter of 2016, Deere's financial services company was 15% of the equipment sales. In other words, 15% of Deere's sales are to itself. And so Deere has to go borrow that money in the financing market to pay for that. You ask yourself, well, why would Deere do that? Well, because Deere has high incremental margins. They've got a fixed cost base. If they're not manufacturing at a utilization level that can absorb all those fixed costs and the profits go negative.
Right.
They don't want to have negative earnings, so they're selling tractors to Finco.
So it's a classic managing of earnings for compensation. I mean, is Deere tied to, let me guess, Deere's tied to earnings per share growth?
Yep, and there's even more shenanigans going on than that. This year...
Because they basically just gunned it. I mean, when the stock went to 95, what you're basically saying is that they had the largest mix ever from Finco to OpCo, and they had the lowest provisioning, therefore the highest earnings ever.
Yep. And,
so it's a peak earnings number.
Yeah, a couple of years ago was their peak earnings, but even now the numbers are artificially high, and the numbers are artificially high for multiple reasons. One, we know that they're over manufacturing relative to what they're selling because they've got to sell a lot of stuff to their Finco. Two, we know that Finco is not taking much, if any, provisions. And then thirdly, I mean, this year versus last year, they changed the accounting of their pension to add $200 million to their net income.
Oh, lovely.
I mean, this year they're only going to earn $1.3 billion in net income per their guidance. So they've boosted their earnings 20% year over year just from their accounting change. So it would be even worse without that. So, you know, they're using every trick in the book, I think, to try to keep the numbers high. But I think the problem is that if you agree with the farm outlook, then this year is not it's not over after this year. Like it's not like you can't manage your business on a fiscal year to fiscal year basis. You got to look at it in the medium term and the long term for reality. And the reality is that we have a record high amount of tractors sitting on farms today. Utilization of tractors on the farm is lower than ever because we've got a record high amount. The average age of tractors on farm is younger than ever. So if you looked at what we need for tractor sales over the next 7 to 10 years, it is significantly lower than the level of tractor sales in the last 7 to 10 years. I estimate relative to peak, it's more than 50% lower, and relative to the average of the last 7 or 8 years, it's 30 or 40% lower. Wow. And so if you keep manufacturing at this artificially high level, and you're funding it through the credit markets, but it doesn't get better next year, at some point you're unable to keep the game going. And that's why I think, you know, if I were Deere's management, I would, you know, be a lot more aggressive than it appears they've been so far. I mean, they finally dramatically slowed down their share repurchase program this quarter. I think they probably looked at OpCo and said, you know, we're really not making any money here this year. If it weren't for Finco helping us out here, maybe we should wait to see what's going to happen before we continue our aggression on the share repurchase.
Well, what happens, and I mean, this is maybe a good spot to kind of wrap up. I mean, what happens typically as you're going into an economic slowdown is a lot of major companies, whether they're GDP plus or not, linked to this cycle or not, they start to feel that. They start to play with the accounting a little bit. Some of them play with it a lot. And then when the actual recession hits, then they're just gassed. So this kind of, I mean, this thing looks, if we're right on a recession developing in the next 6 to 12 months, you know, Deere will be at $60-something. There's no, you won't need to be even really smart at all about anything about Deere other than the fact that they don't do well during a recession, never mind a farming recession. Would you agree with that?
Yes.
Okay. Because that's kind of, if you look at it, again, it's a real good short seller takes the 3 to 5 year view, long-term cycle view like you do, the 40-year cycle, 50-year all-time cycle. And you're like, wow, you know, these guys are totally being short-term to get paid. That's what a lot of executives do. The average tenure of an S&P 500 CEO is like 5 to 6 years. They're just trying to make hay, to pardon the pun, but make hay like when the sun's shining in the cycle that they're in. And it's sad. It's kind of unfortunate because I bet you a lot of people at home own a stock like Deere thinking like, oh shucks, Buffett owns it. You know, it's tractors. You know, it's a lot more than that. So thanks for debunking it. Thanks for being early. I mean, you nailed this, particularly on Monsanto. You nailed this way early, and it. I would not be surprised. I certainly wouldn't bet against you that you're not going to nail it again. So
thanks. Well, I've got my money where my mouth is, so we'll see what happens. But you know, the farm outlook is not good, and I know that the behavior in the games at Deere is not good, and I know the loan book is under provisioned, and there's just a lot of work that I think needs to be done there. But
I like how you summarize it. It's kind of sad, you know, when a company does that. It is a little sad, but congrats on doing some great research. I appreciate it.
No problem. Thanks for having me on.
Yeah, you're welcome. He's Chris Sommers. He runs Blue Pacific. I'm Keith McCullough. If you have any questions, you can find me on Twitter, and you can find Chris right here too.